Now, this question is asked by a lot of people when I meet them. Question exactly is, why don't I invest in individual stocks? Now, I will give the answer to this in a detailed way, but why does this happen? Now, this happens because every few months there is always some new company exploding on social media. One time it's AI stocks, then it's EV stocks, then it's maybe semiconductor stocks. There are so many things going on. The problem is, after that, people start posting screenshots of massive gain online, and suddenly everyone feels like they are missing out. So I understand the temptation. When you see someone turning $10,000 into, let's say, $100,000 in a single stock, like broad market index fund or ETF, suddenly start looking boring. But over the last few years, the more I learned about investing, the more I realized something very important. Investing is not only about maximizing returns, it's also about maximizing peace of mind, consistency, and probability of success over decades. And this is one of the biggest reasons why today majority of my own investments are not in the individual stocks, they are in broad market ETFs and diversified investment. Now, before people misunderstand me, let me make one thing very clear. I'm not saying individual stocks are bad. There are people who are extremely good at stocks picking. Some people genuinely understand businesses deeply. Some people have built massive wealth through concentration. But I also think most people underestimate what successful stock picking actually requires. They think buying stocks is investing. Real investing in individual companies is almost like a second profession. You have to understand balance sheets, earning reports, management quality, valuation, competitive landscape, market cycles, regulations, macroeconomics, technology disruptions, sometimes even politics and wars. And even after doing all of that, you still can be wrong. That's the crazy part. You can do all the research properly and still lose money because the future is uncertain. And honestly, when I look at my own life today, I ask myself a very simple question. Do I want my financial future to depend on whether one CEO executes properly for the next 20 years or even next 20 minutes? Because some CEOs can go on X platform and say wild things and then their stocks can go bonkers. The answer for me personally is no. I already have a full time job. I create content regularly. I have family responsibilities. I have businesses and projects as well. I do not want to spend my evenings tracking quarterly earnings calls and reading 200 pages of annual reports for the next 25 years. And broad market investing gives me exactly that. One of the biggest reason I avoid heavy concentration in individual stocks is because company risk is real, and history keeps reminding us of this again and again. There was a time when Nokia looked unstoppable. I hope you guys remember, if you are of similar age that I am right now. The same case was with Kodak. Kodak dominated photography. Yahoo was everywhere. Cisco was considered untouchable during the dot-com era. Even today, we have companies that looks like invincible. Now, market and technology changes very quickly. Consumer behavior changes, regulation can change, leadership can also change. Sometimes entire industry disrupts and disappears. When this happens, suddenly you will see social media becomes full of experts. But survivorship bias is very dangerous. We only hear about the winners. We hear about Nvidia, we hear about Tesla, we hear about Apple. Nobody talks about thousands of people who got stuck in companies that never recovered. Nobody talks about Palantir investors who bought near the top at don't remember, but right now it's 94% down. I'll put the graph here. Nobody talks about companies that simply disappeared from day to day conversations. Social media only shows survivors. That creates a very distorted picture of reality. You can go check the stock of Zoom as well, just to understand what is hype, and once the hype fizzles out, what happens to the company. Now, another important thing I realized is that even professionals struggle to beat the market consistently. Think about this carefully. Large hedge funds and active fund managers have teams of analysts, Bloomberg terminals, access to management, even institutional research, and decades of experience. And yet, most active managers fail to outperform the index over a long period of time. Now, if people with billions of dollars research infrastructure struggle to consistently beat the market, what makes the average retail investor think they can do it by watching a few YouTube videos or scrolling Twitter or X platform for 20 minutes. And again, this is not negativity, this is just a realization that your time is worth better spent elsewhere than all these things. I personally became much more comfortable after accepting that I do not need to outperform everybody. I just need to consistently participate in long term economic growth of one country or the world. That shift in the mindset changed everything for me. Instead of asking which company will win, I started asking a much simpler question: will the global economy continue growing over the next 20 or 30 years? Historically, the answer has been always yes. Businesses evolve, innovation continues, productivity improves, new company replaces the old companies, entire sectors perform, and sometimes they do not perform, but still the the overall economy goes on. And of course, money printing continues to fuel inflation as well. So broad market ETFs automatically capture this evolution. That is what I love about ETFs. I do not need to predict the next Amazon or next Nvidia. The market itself gradually adjusts. Weak companies become smaller, strong companies become larger, new leaders emerge automatically inside the index. That's a very powerful concept that many people underestimate. Another thing broad ETFs help me avoid is emotional attachment. This is a huge problem with individual stocks. People fall in love with the companies. They stop thinking rationally. They defend bad decisions emotionally because their identity becomes attached to the stock. You'll see people online behaving like they're part of the marketing department of a company they own shares in. And when a stock falls, let's say 40%, 50%, 60% even, people don't think objectively anymore. Either they panic sell at the worst possible moment or they keep averaging down emotionally without proper risk management. My investing process becomes more systematic instead of being emotional. And honestly, one of the biggest lesson I've learned over the years is that investing success is often more about behavior than intelligence. The person who stays consistent for 20 years often beat the person consistently chasing excitement. That's why I often say boring investing is underrated. The more boring my investing becomes, the better my life becomes. I automate my investments. I keep adding monthly, like whether markets are up or down, I continue investing. During COVID crash, people panicked. During the inflation era, people start panicking, selling at the wrong time. During interest rate hikes, people again panicked. During this war, during trade war, people panicked. But broad market investing allowed me to zoom out and continue the process. And this is because of that consistency, my portfolio continued growing over time. Now, does this mean ETFs will never fail? Of course not. Markets will always go through drawdowns. There will be always corrections, crashes, recessions, uncertainty, and fears. But diversification helps reduce permanent damage from individual companies' failures. That distinction is very important. Individual companies can go to zero. Entire economies historically recover and evolve over a long period of time. By the way, I'm not against individual stocks investing. I even myself invest occasionally. I buy some companies here and there that I personally understand or believe in. Again, there is no investment advice in this video, but those positions are very small relative to overall portfolio of mine. I do that for fun, or let's say some of my own education. My core portfolio remains diversified because I know my personality. I know what kind of investing style allows me to sleep peacefully, remain consistent, and focus on my actual life and career. And I think this is something people should ask themselves honestly. What kind of investing style can you realistically sustain for the next 20 years? Because most people do not fail in investing because they picked the wrong stock. They fail because they could not remain consistent long enough. They kept changing strategies, they chased hype, they panic sold during crashes, they became emotional during volatility. Simplicity increases consistency, and consistency builds wealth. That's ultimately why today I focus much more on broad market investing instead of trying consistently finding the next winning stock, because I'm not trying to become rich quickly. I'm just trying to become financially free predictably. Now, I want you to just go through what my portfolio is, because this is my let's say buy and hold portfolio of Sarva. I will go through my portfolio and hopefully you understand what I mean to say in this video. So I made several videos about Sarva, but just to give you an idea in this video, you can go, by the way, check them out as well. I'll link some of those in the description of this, I mean, the cards of this video as well. But the thing is, these are every month or every 2 months I update my portfolio and show how is the progress. So this is my portfolio. There are two portfolios here. One is the Sarva Invest and the other one is Trade. Sarva Invest portfolio, I have not funded this for the last, let's say, 1 year. Maybe a slight funding of $100 or $200 in last 6 months, not more than that. But you can see how it has grown. So this is the full spectrum since 2022 when I have started investing here. You can see constant investing led to this kind of growth. And there must be one more thing I should point out here, that I have not invested anything after, let's say, April. So you can see after April, it's only compounding which is happening. While this is not the case in Sarva Trade, because Sarva Trade I'm constantly investing because I'm investing in the ETFs. Sarva has two portfolios. Again, I'm not going to go into details about how Sarva works. You can go check that out, how the last video that I've made about Sarva. But the important thing again is that you have to keep on investing. As I mentioned, Sarva Invest, I'm not adding more funds into it, but Sarva Trade, I've been constantly doing dollar cost averaging with different ETFs like VOO, VT, and some stocks as well. You can buy gold as well. Some stocks are there, but I won't recommend individual stocks to many people, as I've mentioned in other videos as well. It's important to understand what you're investing in, and no financial advice in this video, by the way. I don't invest in individual stocks, but you can see Unilever, Microsoft, Apple, Realty Income, Walmart in my portfolio, but this is a very small chunk of holding that I have. I do invest in a small chunk for different stocks for various reasons. I don't want to discuss those reasons here in this video. It's a very small portion of my overall portfolio. I've got other brokerage accounts as well. There as well, I don't invest in the individual stocks more than the ETFs themselves. So this is how it works. Again, if you want to see Sarva's portfolio, you can go check that out, linked in the description of this video. If you want to open the account with Sarva, you can use my referral code, which is linked in the description of this video. You will get up to 3,000 dirhams of referral bonus if you use my referral code. Towards the end of the video, you will see some of the recent videos that I've made about Sarva and Stake. Here are the links to the video. Let me know how you like the video. Thank you very much.